Hey guys, Uncle Ray. Welcome to another episode of the Crypto Bellwether. I don't always tell you what you want to hear, but I tell you what you need to hear to make informed decisions. Now this is part of my How to Build a Portfolio to Capitalize on the Next Bull Run series, and I'll put this in the playlist as well. And I've been working one-on-one helping people get a game plan and a roadmap with some rules to help them capitalize on the next bull run. If you think you need some help with that, we'll talk about that at the end of this video. But in this video, we're going to go through the 4 steps that you can implement to actually be conservative and aggressive at the same time. Now I know that doesn't make sense, but it will at the end of this video. And remember guys, it's crypto, so we're always at risk. This is not like buying gold, real estate, or a stock. But this is about as conservative and aggressive as you can get, in my opinion. Now, the only thing that I would say could be more conservative is just to dollar cost average into Bitcoin, and that's it. But if you're going to build a portfolio, in my opinion, this is one of the best strategies that I've personally know how to do. And I'm excited to share that with you. Now, step number 1, guys, is that what we want to do is always think about the downside. Now, I have to tell you, I've been around investors my whole adult life, and I've never seen so many people disregard the downside, and that's how you're going to get wrecked. You always need to consider the downside first. Always review that downside and then go from there. Now, so to be conservative in any portfolio, I personally believe that at least 25% should be in, say, Bitcoin and Ethereum. And realistically, depending on how big your portfolio is, it might be, say, 25% Bitcoin and 25% Ethereum. But we're going to use this as basically like a $10,000 portfolio. So with $10,000 portfolio, basically what we want to do is put 25% in Bitcoin and Ethereum, just like you see on the screen. Now, why do we want to do that? Well, that's the conservative side. Here's the thought process. No matter what happens with the other 75% of that portfolio, we lose it all. Hopefully, if things pan out, Bitcoin and Ethereum gave us our money back, right? All we need is a 4x and we're good to go. We live to fight another day. So that's why you want 25% in your portfolio. Now remember, this is not financial advice, but this is one of the ways I do things. Now, the other 50% of the portfolio should go a little more aggressive, higher risk reward, but still fairly conservative, like your mid caps, HBAR, Graph. Maybe you want to get into like FET as far as AI or Matic. Right? It's still fairly conservative, but has a bigger upside potential. Now, maybe you want to get another 20% that gets a little more aggressive, or actually a lot more aggressive, like Jasmine or Humans or Delencia. So those projects are pretty high risk reward, but it's only 20%. Now, depending on your risk tolerance, you can adjust all of these metrics. But for the last 5%, those are for the high rock and roll risk reward type projects like meme coins or ICOs. But when you step back and you look at that portfolio, overall it's got it's conservative, semi-risky, and higher risk. But now here's something that everyone needs to really think about. And that's rule number 2. When you go through like the 50% for sure, you want to make those more diversified. Now, for instance, I work with a lot of people that own a lot of banking tokens. I do as well. However, if I had to rebuild my portfolio, which I've stacked a lot of bags last year, I'm not going to unstack those, but now I have a better understanding of how things rotate and how narratives change, because the smart money, the whales guys, even in the slow times, the good times, it doesn't matter. They want to move their money around because they know when they roll large sums of money into any project or any sector with a sexy story, it's going to start to pump. People are going to FOMO in and they're going to take profits and roll out. So one way that really gets you a better opportunity for a bigger upside is if you have like a layer 1, you have a gaming token, an AI project, a meme token, a layer 2 that helps, say, scale Ethereum, a metaverse play, and when that money starts to rotate out, hopefully you're in position to capture that, because the biggest money is made when your bag is stacked at the bottom, just like all of last year and probably what's like hopefully about to come up. So keep that in mind when you start stacking and thinking you're diversifying, because realistically, guys, like my banking tokens for the most part are probably going to pump at the same time and roughly about the same X-wise, right? There might be a little bit of difference, but it does. I would rather have a diversification into other projects than 3 or 4, in my case 5, 6, 7, or 8 of the banking tokens. It just doesn't make sense. But it is hard to figure out which projects are going to pump the highest, because obviously we will not know until it happens. And that's actually why I started working with people and coaching one-on-one, because even with my background, I started FOMOing in, or not FOMOing in, but I started watching these projects and really starting to like them. And next thing you know, I looked up and I had like 40 projects that I had been stacking. And now when it comes to FOMO, guys, I never ever FOMO in. I want to make that clear. That's part of my rules, period. I don't chase anything, especially in a bear market. Now, the third thing, and I think is immensely important, is once you start to get a pump going, once the bull market starts, when you catch a 3x, I'm pulling out my profit, my initial investment. Not all my profit, but my initial investment. So, for instance, if I have a bag that is $2,000 and it gets to $6,000, I'm taking that $2,000 out. And throughout the bull run, when everything's starting to pump, I'm going to start dollar cost averaging out all the way up, and I'll use technical analysis to really give me that final outcome that I'm looking for. Now, that being said, here's where the risky conservative portfolio really comes into play. If we're fortunate and if everything goes to plan, our portfolio has been doing very well. Even the conservative stuff, everything has been pumping. Well, once we start to get, say, the 5x, 7x and on, we start pulling those profits out all the way up, right? Well, we take a certain percent of those profits and we put them in the rock and roll major narratives at the time type projects. We probably going to be into gaming and AI or whatever's pumping, meme coins, ICOs. It doesn't matter, because it's a small percent overall, but it's a pure profit. So let's look at the end game. Let's just hypothetically say at the end of the bull run, we had created a 15x, and that's across the board, right? So that means our $10,000 would be $150,000. So, but we took out 2 or 3,000 along the way and put them in really, really risky projects. Well, what happened with those risky projects? Well, if they pump, they may actually have outperformed with that $2,000 or $3,000 the entire amount of our the rest of our portfolio. So that's what we really want. That's what we're looking for. But even if we lost every bit of it, every project was a rug pull, right? We got an ICO, didn't even get our tokens, meme coins pumped, but we missed it. Doesn't matter, because now at the end we still had a 12 to 13x. Yeah, we had a 15x, but it doesn't matter. It's a win-win. And if everything works out, maybe we turn that 15x portfolio into a 25 or 30x portfolio, but either way we did it with the least amount of risk as possible. Now hopefully that all makes sense to you guys. Let me know your thoughts in the comments if you have any questions. Now if you want to work with me one-on-one in my coaching program, what we do for $250, we go through, look at your portfolio, and at the end of 3 to 5 video conversations or phone calls, you're going to have a roadmap that you can use with rules and a game plan and a process in place to help you capitalize on the next bull run. We'll be talking about dollar cost averaging in or out if you need help with that, and you'll 100% have a different mindset than you probably do now. That's the ultimate goal. Now guys, whether you work with me or someone else, you have to have a game plan, in my opinion. Now again, not financial advice, but this stacking hope and not knowing when to get out or how to get out, guys, you got to have a plan and work that plan. Anytime I put on a trade, stack a bag, it doesn't matter. I have every outcome already planned, and I just work that plan. And that way I don't have anxiety. I don't have to worry about what's happening, because right when I see it, I know how to react. But guys, when the FOMO starts, right, imagine the next bull run and you're at that 3x, and now you're at that 5x, now you're at that 10x, and everyone's telling you you're crazy to take any profits. Well, I don't care how crazy it gets. I've already taken my initial investment out. I have no risk. I have, no matter how bad the next bull run is, if I get a 3x, I'm good to go for the following bull run, right? And every time I get another 2, 3x, I'm going to start peeling off those profits. And then I'm going to put those in a stable coin or in Bitcoin. That's just me. That's not part of this portfolio. You'll have to decide that. But then I'll start putting a small percent into the ones that are really pumping. Because guys, the narratives are always going to be rotating. That's one thing that I've really come to understand about crypto. Is yes, tokenomics matter. Everything matters in the big picture and in the long term. But when everything's going, it's really about narratives. And the whales create these sexy stories, these sexy narratives, and they just rotate their money around. So you want to be prepared for that. I know I'm rambling, but anyway guys, let me know your thoughts in the comment section. And remember, have a game plan. There's 1,000 ways to create a portfolio, but you want one that meets your risk reward tolerance, and you lay it out to meet your long-term goals. Now for me, I go bull run to bull run. I highly recommend that. I see the number one thing that I've seen, guys, in working with people is that a lot of them have taken a small amount of money and turned it into some real money, and they watched it come all the way back. And some of them have less than they started with, but most of them just have a little bit more, and they went from nothing to massive gains back to nothing. And I don't want that to happen to you guys. I got a new saying, then I'm going to let you go. Either take your profits or you become the profits. That's the way it works, guys. When something starts to pump, whether you take your profits or not, when I take my profits, that means someone took my place, right? So if I make, $100,000, I pulled that out of the crypto market. Well, I took it from the people that didn't want to get out. I say that with love. It's not financial advice, but guys, really consider taking those profits. Anyway, that's all I got for you guys. Hopefully this helped you out a lot. I will put this video in the playlist, and if you have any questions, leave it in the comment section. Hit that subscribe button and the like button and come back and be part of this community. Take care, guys.